Hello, everybody. Welcome to today's session. I'm Andrew Wilkinson with Interactive Brokers. I'm thrilled today to have three distinguished guests with us, each of whom brings firsthand experience from the trading floors of, we're going to go back a quarter century to the dot-com era. Steve Sosnick, Jeff Praissman, both formerly with Timber Hill, part of Interactive Brokers, the foundation of Interactive Brokers. Steve is now our chief strategist here, and Jeff, former options trader, is on the marketing and education team. And Scott Bauer, who was a proprietary options market maker or trader on the SIBO floor during what was one of the most volatile periods in market history. Welcome, Scott. How are you?
I am great and very happy to be here. Thanks for having me.
You're very welcome. So together, these gentlemen are going to help us explore whether today's market, driven by AI enthusiasm and a concentration in technology and central bank dynamic, is somewhat echoing the speculative excesses of the early 2000s, or are we entering uncharted territory? Recently, there have been comments from the Bank of England, from JP Morgan Chase CEO Jamie Dimon, all about whether we are potentially heading towards some sort of a speculative excess. Now, if you think back to 1995, Fed chairman at the time, Alan Greenspan, warned about valuation and excessive prices for equities in what was termed the irrational exuberance. But that market kept going up and up and up for a further 5 years. So what we're going to do today is we're going to see what it was like to trade through what's known as the dot-com boom and bust. We're going to talk a little bit about valuation metrics and investor behavior across other areas, and whether today's AI-driven optimism is a healthy evolution or is it a warning sign? So let's jump straight in. I'm going to ask all of you, and let's start with Scott. Tell us a little bit about where you were back in 95, 2000, 2002. What were you doing? What did it feel like?
I was trading on the floor of the SIBO. I was a market maker. I was partners in an options trading firm called BOTA, B-O-T-T-A Capital Management. And I was trading in the Coca-Cola options pit for a very long time. In 95, 96, I had started much earlier than that. And then when the dot-com era started, just shortly thereafter, 97, 98-ish, some of these stocks started getting listed, trading options, Amazon being one of them. And when Amazon was listed, and Jeff and Steve, Andrew, back in those days, back in the 90s, when a stock was listed on a certain exchange, it was only there. So a stock that was trading on the SIBO was not trading in Philly. It was not trading in New York. It was not trading on the P Coast in San Francisco. So Amazon got listed, and it was really one of the first, let's call it, internet-driven dot-com type of stocks. And many traders did not understand how to trade this type of volatility. Many traders traded stocks like myself, Coca-Cola, IBM, stocks that had pretty consistent volatility. I actually became the single only option market maker for Amazon.com options when that came out, because other traders did not want to go into that pit where it was at and deal with that sort of volatility. And that was the start of, I'm not going to call it excess at all, but I'm going to say that was the start of an era of implied volatility that many had not seen before. And that just got the ball rolling to stocks like Yahoo and AOL and other stocks like that. And I would tell you, it was a pretty wild time. It was a fun time.
Let's ask you the same question. Where were you? What were you doing? How did it feel?
See that building over there? That was where the Timber Hill trading desk was. So that was where I was at the time. It's a funny thing you say that, Scott, because one of the big coups that we thought we had was when we applied for and got the listing for Netscape on the Pacific Exchange. And we had very similar problems. I spent hours on the phone. My job at that point was managing the risk for the various equity options that we were trading. And I would spend inordinate amounts of time on the phone with our specialists on the Pacific. And she would call me up and go, these markets suck. They're terrible. They're too wide. And I'm like, you're right, but we have to redo the models to get them. Fast forward, by the way, that specialist named Kathy Clay, who just recently left as head of the SIBO options,
Right.
to go head S&P. So worked out for her in the end, I'd say, by the way. But I just remember that it broke all our models. I will say, fast forward toward the end, we actually had some spectacular. We made a lot of money in those days because spreads were wide. Once we figured out how to do it, the spreads were wide. The volatility was enormous. We were always, because Thomas had issues in the crash of '87. We were never allowed to have major downside exposure. The upside was really good. Actually, the flip side was oddly enough better for us, but that was proprietarily, not for the industry as a whole. But it was nuts. It was really, truly unprecedented.
Yeah.
But one of the parallels that I would say is around that time, individuals got empowered in a way they never had before, particularly in the options market. I brought this up yesterday because I was at a conference with various people, one of the guys from E-Trade, and I made this point that individuals have taken another generational leap forward in terms of their involvement in equity markets and options markets. And I said, the E-Trade guy said, let's light this candle, Stuart, or whatever it was. And I didn't mean to pick on him. That epitomized how the game started. So I think, as we'll get into it more, my comments would be, I think a lot of this is history doesn't repeat, but it's certainly doing some rhyming.
So, Jeff, perfect segue. You're a hybrid here. You work with Timberhill, but you were on a floor. Baptism of fire. It must have been a little bit like being in the crowd at an Eagles-Giants game.
Yeah. So at that time, I was on the floor. Eventually, I ended up moving upstairs to work with Steve as well. But you have to remember, too, like there were so many things going on during that period on the floors, right? Not just with the .coms, but just structural changes. That was, Scott had brought up that they were only listed on one exchange. They were until they weren't. And then they began multi-listing. And so those spreads went, and we went from fractions to nickels to pennies. And the combination of not just the volatility in the markets, but just the changing format and structure of how things were traded, and those spreads going from super wide to super narrow, and that volatility not changing really. And now you have less room for error. I was actually in a pit that Apple was in, and I just remember the specialist making at one point, this is after multi-listing, a 10,000 up choice market, which is like the worst thing to do, because there's and that's just like the irrational thought of, we got to get the volume. It doesn't matter. We're going to get the volume. So there were so many things going on at once. And I know that's going a little bit off the tangent of what this podcast is about, but it was a crazy time to be on the floor.
If I may, can I just interject how did multi-listing start? You're talking to, unfortunately, the culprit. And what happened was, and I found this later.
You are the demise.
This was later confirmed to me by Sandy Fruker, who was the head of the Philex at the time, that this was intentional, but I didn't know it at the time. And we were the specialist in a company called Visteon, which was an auto parts manufacturer. It was multi-listed because it was after the grandfathering, but of one exchange, but before the real multi-listing stuff happened. And they got taken over by Ford. And it was customary in those days, if there was a stock merger, that you would trade the stub, which would be Ford, but like with a 47 multiplier instead of 100, and you would just let those run out. Our specialist on the Philex at the time, Jeff, if you remember him, he comes up and he's like, the Philex is asking if we want to take Ford. And I said, are you serious?
Yeah.
And he's, yeah. I'm like, it would, like, of course we'd take Ford. Why wouldn't we?
Right.
And then I thought for a second, hold that up. This is a SIBO. This is the SIBO's stock. I said, let me at least talk to Thomas before I start this. And I went into his office. In those days, he would, if I was here, he would be like there. And I'm like, I explained to him, I said, I think I might have just started a war here. And he looked at me, because I had to explain the whole thing to him. And he said, it's going to happen anyway. Go for it. And I found out later that was choreographed, that Sandy Fruker wanted to start that war, even though it was believed that Philex was in the worst position because their only really good stock was Dell. But knowing that if he did it with us, we would take the bait and that Thomas wouldn't be afraid of it. And so I took the bait, and then basically easier to ask permission than forgiveness, or forgiveness than permission. But that is how it started, literally.
Scott, let me come back to you. Steve mentioned earlier on about history doesn't necessarily repeat, but it rhymes. Back in 2000, many companies, and this is behind the Greenspan warning, wasn't it? Many companies traded at extreme price to earnings ratios with little or no profit. And somebody on this call probably knows when Amazon actually turned profitable. I think it's within the last 15 years.
Yeah, I was going to say probably 15 years after their IPO.
Yeah, along the line.
Yeah. Today, we're seeing highly profitable tech giants. NVIDIA's a printing press, isn't it? But those firms are dominating market indices. Does profitability justify current valuations, or are we repeating history in a different costume, would you say?
So that is the big difference between what we're seeing now with a lot of these AI companies. And I'm not talking about the big ones like NVIDIA or Alphabet, Google. Is back then, any company that just put a sign up on the internet, people were going nuts over it. People were buying into it. Valuation didn't matter. Profitability didn't matter whatsoever. And so even though we're seeing major concentration now of the big guys out there, of the NVIDIAs, Apple, Microsoft, Alphabet, Meta, probably throw Broadcom in there, there are a lot of parallels, but some differences between now and the bubble that we saw back in the late 90s. And I think the big thing there is the products or the innovation that those companies were coming out with back in the late 90s, they would start something and nobody would expect that product to actually really do anything for a few years or come to market for a few years, where with AI now, we almost have that immediacy. So we almost have a company that comes out with something and we're using it right now. So I think that even though there's these massive valuations for many of these companies, they are companies that are adding value. Now, are they overvalued? Maybe. Are they undervalued? Maybe. I think that's the big difference now. And so if you can get beyond the concentration of the big guys into some of these smaller companies, but companies that actually have a product that are being put to use, then there is potential there. And I think that's the big difference between what we're seeing now and what we saw in the late 90s.
Jeff, the top 10 stocks in the S&P now represent about 40% of the index. That's higher than the dot-com era where that top 10 represented 30%. Is the concentration a red flag or a reflection of economic reality?
So again, I go along the same lines that Scott said. I think there are some differences, because what was it, like 30% around the dot-com peak, probably similar situation. Those 7 companies or whatever, the top 10 companies, like they really do have, these companies are really like, they're kind of scaled correctly. They were real companies beforehand. It wasn't like they just came out with a sock puppet and all of a sudden they're worth $1 billion or $100 billion. Like these companies were real companies before this AI came out, and they're just taking the next step in evolution. And again, like whether or not it works out as planned or there's a step back, there's at least in my mind a foundation to these companies, and there is a value there. So it's not just a house of cards where you pull one out, it all falls apart. Again, like maybe AI doesn't work out quite the way we think it is, but it's still going to work out in some way or another for these companies and maybe some other ones as well.
It doesn't feel like it did back then, where you can see that there is no strong business model behind these companies and that they end up going to the wall. Dave, you've been watching investor behavior among what interactive brokers investors do. Are they behaving differently, would you say, than they did in 2000? Is there more caution perhaps, or are we seeing similar speculative patterns?
It's so hard to say because in those days we were really prop traders with this like little side business, this offshoot web-based brokerage. So I don't have the frame of reference. I wish I did, but I don't. Although I would like to offer a little counterpoint, not push back on what Scott and Jeff said, because it is indisputable that the companies that are leading this rally are earnings and cash flow generating machines. But what started to bother me now is the circular dealing that we're starting to get into. And ultimately, the company it all in the deals that have led to Oracle and AMD shooting up, it all revolves around OpenAI and their halo effect and their access to capital. And so I've asked the question several times, how does a company with $12 billion annualized revenue effectively commit to spending $300 billion over the next 5 years? Where does that come from? And I happened to mention this on the radio the other morning, and the other guy who walked out, who was in the green room, who was actually a professor at Yale, and he was like, yes, nobody says this. He goes, I calculate $1 trillion is necessary to build out AI. And you do have to wonder, where is this coming from? And especially if it's not, it's fine when it was Microsoft and Meta and Amazon buying chips from NVIDIA, because yes, that's circular, but ultimately we know where that money comes from. It gets a little bit different if we're going to have to rely on the capital markets to finance this. And Jeff, you made the point, about which companies were profitable coming in. So were Global Crossing. So was Northern Telecom. So was Lucent. So we believed was Enron. And so we believed was WorldCom. And these companies, just as there's the rush to build data centers, these companies were rushing to build bandwidth in the late 90s. And I will stipulate that the bandwidth was necessary. It was required. The internet was everything that we were promised and then some. But there was certainly some bumps along the way. And I feel that's a stage we're in now, as we've outkicked the coverage to a certain extent in terms of some of the enthusiasm. Can you guys recall a situation where a piece of good news from a stock would take it up from a huge cap stock like an Oracle or an AMD, would take it up 30, 40% on one day? I don't recall this. That's where I'm starting to get a little fudgy.
Not without it being an acquisition.
Getting short of that. But Scott, you don't recall this. You've been at this a long time. Jeff, you don't recall this, do you?
No, I'm thinking this. There's a merger. Never mind. I'm thinking AOL Time Warner, but that's a merger. So that's
mergers are different.
Andrew's point exactly. But yeah, no, it's like irrational exuberance, right?
Yes.
I don't want to use that term, but I'm just saying that let's call them high levels of enthusiasm, shall we say? Irrational exuberance, that like transitory was a big misspeak by the Fed. So we'll leave that one aside.
Yeah, I think down the road, whether it's 5, 10, 30 years down the road, that move that we saw in Oracle is going to be a case study that people are going to look at and say, that was one of those events that, maybe shift the landscape in this marketplace. Because moves like that on smaller cap stock.
Yeah.
Stock like Oracle, come on.
And in the case of AMD, where there's really not much money, basically OpenAI's halo is allowing them to basically be given stock for free in AMD, but yet the stock rallied 40%. So there's a lot going on. By the way, in these smaller caps, you asked about customer activity, Andrew. It's become fairly routine to see stocks go from 2 to 25, then eventually settle back down in most cases. But the amount of just, I'm not going to say buy and hold, buy and chase that we do, that we see in a lot of smaller names is very prevalent, although that's more of a sideshow than the main event.
Yeah. Jeff, let's come back to you. You mentioned earlier about the differences, the fundamental differences in the marketplace that have changed. From a regulatory perspective, how has the regulatory environment evolved since the dot-com bust? Are our current safeguards sufficient to prevent a similar collapse?
Obviously, people are always ahead of regulatory, always going to face these challenges, right? So there's more retail probably trading now than there was in the past, just because it's so accessible, right? People have phones. That wasn't really back then. People didn't have cell phones like that we do. Trading costs have gone down. So I think there's always going to be people out there that can find the blind spots and take advantage of those gaps. So the SEC is always going to be kind of playing catch up. I think the real question is whether or not it's anything that, are the guardrails enough to prevent any kind of catastrophe, or are they not enough and people are just going to, something bad is going to happen? Hopefully there's a lot of smart people at the SEC and other regulatory agencies. And I think at the very least, there's enough guardrails in to prevent any kind of, we're not kind of like a crash in 1929 or anything, but there's always going to be people that are smarter, that are motivated by profit, and they're going to find those gaps. And anytime that happens, it could really amplify, and it's going to amplify the market volatility, and that could create a significant correction at any point.
Scott, lessons learned. What lessons do you think from the dot-com bust? What do you believe are the most relevant to investors today?
So that's a great question, because my mindset is always the trader mindset as opposed to the investor mindset. That being said, I think when you get into a situation where you do see stretched valuations, and I'm not saying that necessarily because we're at all-time highs right now, there's stretched valuations. Maybe there are, maybe there aren't. There definitely were in the dot-com bubble. It is always prudent to me. It is always prudent. This has been my mindset since day one trading on the floor, to have the opportunity to just have some protection in your pocket. So for investors, does that mean have some downside in a portfolio while you're holding long positions elsewhere? Yes. For traders, does that mean that you can have 20, 30, 50 bullish positions, but still in your pocket have that insurance, whether it's downside puts in one of the indices, or maybe some upside VIX or whatever it might be? Yes. And I think what traders especially don't understand is you want to have that insurance, and you actually hope that it goes out worthless. You hope that the insurance you bought that maybe was on sale when things were relatively cheap from a volatility standpoint, you hope that goes out worthless. Just like when you buy your car insurance, your homeowners, whatever it might be, you hope you never have to use it, right? And so I think the lessons learned from back in the dot-com bubble would be that maybe everybody is a little bit more cautious now, though some of the traders that I still talk to maybe haven't learned that lesson properly. But I think from the institutional side, and Steve, maybe you can speak to that a little bit better, I think that warning from way back when still resonates.
All I can say to that, Scott, is amen. My mantra has been, don't fight the tape, but you need to insure against it. And you hit all my usual talking points. You could tell we came from a similar background and mindset. I will say that I was at an institutional conference a couple of days ago, and it was basically like the mood in the room was, we know this is stretched, we know this is difficult, but we can't go back to our clients underperforming the market. The FOMO from that room was palpable. It was interesting. That was definitely, to me, an eye opener. I think, these people, if you're an institutional manager and you don't want to underperform your benchmark or underperform your peers, you have to hold your nose and do this, which would be the perfect opportunity to say, okay, if for professional reasons I have to own this stuff, but I'm not comfortable owning this stuff, how about using some insurance? And like you said, we don't want our insurance to pay off necessarily, but it lets you sleep better at night if you have it.
For sure. Final question for everybody. I think we're all of the same volition here that the market is potentially overvalued. Everybody's talking about that. But let's stay with Steve. What signs would you be looking for a potential correction?
I think some real slippage. I think right now, I looked over the market as we're taping this, and we were higher, and my mindset was, why are we higher? And then I realized we're open, so of course we're higher. It's a business day, so why wouldn't we be? I think I actually was doing something involving the crash of 87, which was not really germane to this necessarily, but I realized that there were some real warning signs ahead of that. We haven't really seen that in terms of the end of the momentum trade or the willingness of investors to not buy dips, the willingness of people not to chase rallies, the willingness of institutions not to hold their nose buy. I think you need to see that. My big fear, though, is that because everybody's been so conditioned to buy dips, number one, the half-life of dips is getting incredibly short. They're short, shallow, and are gone sometimes by the end of the morning. But the second part is when there is that first leg lower, people are going to rush in to buy, and that's going to be scary, I think, to some extent, because if there's a real wave out of this stuff, it's difficult to know in this environment when a large wave is actually a tsunami, and we won't know that. I think we have, but as of now, as much as I'm concerned about this, I can't just say keep shorting the market or anything like that, because you're going to get blown up.
Yeah, you'd be right.
If you want to short the market, do the opposite, fight the tape, but have insurance using upside calls so that you limit your losses and so that you can participate. I do think that's being used by institutional investors in some extent. Scott, correct me if I'm wrong, but skews are relatively flat historically.
Yeah, they're very
because I think
modest.
there's this, and I wouldn't say it's less because of a demand for puts. I think that's always there, but I think it's also just that's FOMO insurance is upside calls.
There's no doubt about it. I think there's also a bit more sophistication in the marketplace in many more ways that people can hedge something. But you're right, Steve. Right now, we can call it FOMO or not. You're seeing that to the upside. And that historically, when we've seen that during the meme craze, whatever it might be, that chase for something, that's typically where we've seen the market maybe get into some troubles, whether it be short term or long term. So I definitely agree.
Yeah,
Final
I would just add, obviously the theme of this is there's 7 to 10 stocks that are really pulling this market up, but we have earnings season coming up starting next week, really in full force with those banks on the 14th. Let's see what every company has to say and look at these corporate profit margins and see what these CEOs and CFOs have to say about where they think their particular industries are going, right? So if 10 stocks are doing great, and let's just say someone in the oil and gas industry, all the oil and gas companies are saying we got some problems coming up, like maybe that's a little bit of a sign to say, okay, even though the market's coming up, maybe we need to worry about the 85% of the stocks, the sectors that may not be doing great all of a sudden.
Jeff, you might need to fact check me on this one, but is it true that there's typically a market crash when the Philadelphia Eagles win the Super Bowl?
So there's just chaos in the street, Andrew, when the Eagles win or when they lose. It doesn't matter. It's just chaos either way. Steve will attest to that, spending some time in that great city of ours.
Yes.
Jeff Praissman, Steve Sosnick, and Scott Bauer, thank you very much for being my guest today.
Thank you so much.
Thank
Great to talk with you guys.
Very much.
All right. And to the audience, I hope you enjoyed today's edition. And remember, if you did, subscribe wherever you download your podcasts from.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice. Options involve risk and are not suitable for all investors. For information on the uses and risks of options, you can obtain a copy of the Options Clearing Corporation Risk Disclosure document titled Characteristics and Risks of Standardized Options by going to the following link: ibkr.com/OCC. Multiple leg strategies, including spreads, will incur multiple transaction costs.